What's up, everybody? Joe Brown here. This is Heresy Financial, and over the last couple of days, we've seen interest rates start to spike, and especially towards the longer end of the curve. We see long-term interest rates just surging over the last couple of days. And guess what? The economy cannot handle it. The economy cannot afford it. So, given that, number one, why are rates increasing? And then number two, what's going to happen as a result? Ready? Let's dive in. So why are interest rates rising, especially at the long end of the curve? The main answer is because the biggest player is pulling out of the markets. If we remember, prices of bonds and the interest rates of bonds, they are inversely correlated. Here's why. If I owe you $100 at a 1% interest rate, I owe you $101. There's a contract between us called a bond. That is a debt instrument. That means I owe you $101. That's principal plus interest, 1%. But you don't have to keep that. You can sell that contract to somebody else and let me owe that money to them instead. But if you can't sell it for $101, which is what it's worth in the end at maturity to you, you're going to get $101 back. You might have to sell it at a discount. So let's say you have to sell that to somebody at $99. So you sell it to somebody at $99. That means they paid $99 for something, but they're going to get $101 back. This means the market has moved interest rates to 2%. Roughly. So as the price of debt sells off, debt prices come down, that means the interest rates on debt go up. Now let's say you're able to sell it to somebody for $101. How much is that person going to get back? $101. They paid $101, they're getting $101 back. What's the interest rate on that? 0. So if you have a lot of money coming into a debt market to buy up a bunch of debt, that's going to drive interest rates down. If you've got money leaving the debt market, more people are trying to sell debt and less people are buying debt, that's going to drive the prices of that debt down, which makes interest rates go up. And the Federal Reserve, the fact of the matter, is tapering. And if you look at their balance sheet, you can see that over the last 2 months, they've purchased an average of about $100 billion per month, adding that to their balance sheet. Contrast that with the 15 months prior, they were purchasing about $120 billion worth of assets. They are pulling out of the market and they plan to not have any more net purchases by March of 2022. That's just 3 months away. Following that, they plan on actually hiking interest rates. So the Federal Reserve targets a small range for the shortest term interest rate, the Fed funds rate. They target a short-term range for that interest rate. Since that's short-term, everything else is built on top of that. And in a normal market, the longer your maturity of your debt, the higher the interest rate is, because there's more of a chance of bad things to happen, more of a chance of default, more of a chance of inflation along the way. And so in a normal market, the longer the debt, the higher the interest rate. And so if the Federal Reserve starts hiking short-term interest rates, that is going to also have an impact on long-term interest rates going up. Again, both of these things work together. They're purchasing less debt than they were before. That raises interest rates. They are actually raising short-term interest rates. That's going to have an impact on allowing long-term interest rates to rise as well. So what's the problem with interest rates going up? In fact, many people like myself preach about the problems of artificially low interest rates, easy money environments where credit is extremely easy to get, especially for the ones who need it the least, and that contributes to inflation and malinvestment. So what is the problem with tightening, with raising interest rates? Well, ultimately, I don't think that's a problem. I think you're getting closer and closer to the way that the free market would be pricing things. I don't think they should be controlling interest rates, but I think you're getting closer to what the free market would be setting there. You're allowing some of the failure to happen. You're allowing the default to happen. You're getting the market closer to what it would be absent that intervention. But I think the real problem happens with what comes after, because there is so much malinvestment buildup. There is so much rot in the system. There is so much debt over leverage in the system. Take a look at this chart. This is non-financial corporations' total debt. You can see all-time highs. It is just astronomical, the amount of leverage that's in the system right now. And keep in mind, this is on the backs of the lowest interest rates in history. What happens if you're maxed out on your credit cards, you can barely afford your minimum payments, and you've got a 0% introductory rate? What happens when that interest rate goes up to 5%? If you couldn't afford your payments at 0%, you can't afford your payments at 5%, even more. You're bankrupt, you're insolvent. And that's exactly what we are going to start seeing happening all over the economy. You're going to start seeing players get knocked over. You're going to see insolvency, you're going to see cash flow restrictions, you're going to see deflation start to take place, you're going to see a deflationary death spiral start to occur, and the Federal Reserve is going to step back in, undo all the tightening, undo the raising of rates, undo the winding down of their purchases, the flattening out of their balance sheet. They're going to have to purchase trillions more. They're going to have to take rates to zero all across the curve. And that's why I think that this is a problem. Not because the actual tightening is a problem, but because they don't have the guts to stick with it. If they just let things go, let things collapse, and let the forest fire burn the dead wood, then the nitrogen gets deposited in the soil and becomes fertilizer for the next generation of a much more healthy forest. But if you continue to intervene and you continue to stop that failure from happening, eventually the economy overdoses on the stimulus and the assistance and falls apart, and you burn off the topsoil because the inevitable fire that happens as a result is far more devastating than any of the small ones that would have happened instead. So in summary, interest rates are spiking right now, especially at the long end of the curve, in anticipation of the Fed completing their asset purchase taper and starting to raise interest rates in just a couple of months, and the economy cannot handle it. It is too over leveraged. We're going to see some sort of a crash get started as a result, and because of that, the Federal Reserve will have to undo all the tightening that they started. As always, really appreciate you guys. Thanks so much for watching.